Our next guest remains very cautious and says seeing the S&P 500 fall to the mid-4000s is not unreasonable. Citi's head of equity trading strategy, Stuart Kaiser, joins us now. Stuart, great to have you with us.
Hi, how you doing?
So how are clients positioning at this point for that downside or for the bounce?
You know, I think most people are positioned for the downside. Today was a little bit of a wake-up call. You know, you got those sort of phantom headlines early in the day and, you know, very, very aggressive squeeze higher. So I think that, you know, tells you, to Carter's point, there's a lot of washed out positioning and a lot of negative sentiment, and that does open you up to kind of squeezy type risks. But the bottom line is the questions we're getting are about knock-on effects from the tariff. I mean, we could sit around and agree, hey, around 4,900 is priced in the tariffs that have been announced. But what the market is now worried about is what does that mean for growth on a go-forward basis? Because certainly recession risks aren't fully discounted by the market yet.
You heard Tim bring up credit correctly. I mean, 1 day, 2 day move in credit's been astonishing. And the move in the bond market today was probably one of the biggest moves we've seen in 3 or 4 years. Speak to that.
Yeah, you know, credit, for instance, you know, we've seen a lot of hedging in credit probably for the last 4 to 6 weeks. HYG puts at various strikes kind of somewhere in the mid to high 70s. So not too surprising to see some weakness there. I think institutional investors were kind of concerned about that space going in. Yields today, you know, very good question about what's going on that side. You know, we have a couple auctions coming up, which I think is going to be very important. You know, there's some concern about dollar-based trade, maybe reducing demand for dollar-based bonds. So it definitely raises your awareness when you get that, when the bond equity correlations seem to be breaking down, because, you know, one side of that trade is going to have to be confirmed. A lot of folks kind of look at the rates market as usually being right. So I do think that move in yields has you kind of on your toes a little bit going into the rest of the week.
Stuart, talk about the semiconductors sector, because, you know, not only was this where we were getting all our growth, but obviously where some of the heaviest positioning was, and where we pulled back almost 30%, and where we really made no relative money since last summer. I mean, at what point, because again, semis kind of lead, right? At what point have they washed themselves out first? And what would you be looking for in price action, and or what you want to hear from the companies around earnings?
Yeah, I mean, it's a great point. I think semis was up about 3% today, at least S&P 500 semis were. I would put them kind of in what I would call the core positioning bucket, which was the stocks were both high momentum and high growth in February when we hit this top. You would have had a number of semiconductor stocks in that basket. And, you know, what we need to see is some stability there, frankly. I mean, those stocks are down almost 8% last week. We did get a bounce today. So I think I would put them kind of right at the vortex of kind of this positioning dynamic. Earnings, you know, earnings are going to be the biggest wild card we've seen in a while. You know, if you're a company here, you kind of have three choices, right? You either defend your numbers, and you better have a lot of evidence for why. You kitchen sink stuff. In that case, you better hope your stock is really washed out and there's money to buy. Or you have this middle ground where you kind of like punt it a little bit and talk about uncertainty. I'm not sure what the semi stocks are going to do, just because they're so exposed to tariff risk. So it's going to be unlikely that they're going to be able to successfully defend numbers. So they're going to kind of be in one of those other two categories. And I think that does open up some risk around earnings. But look, if the response to payrolls last week was any indication, you know, fundamental data might not matter right now anyway. We may just be back to tariff headlines.
Now, when you looked at that intraday change day, right, we got out that headline that said Trump was going to delay the tariffs by 90 days. That turned out to be false, but the markets moved positive on that news, then moved negative. Is that some sort of indication that if we do get some sort of reprieve with these tariffs, that markets are going to go kind of off to the races? Or what has this done to consumer and CEO confidence that even if this gets resolved, is that still going to be an issue for investors moving forward?
Yeah, I think what it tells you is there's a lot of squeeze risk here and sentiment's really negative. And I think the knock-on effect of that move was I think you really hurt the shorts on the way up. And I think that was a reminder to them that the risk-reward around being short to the market here is much more balanced. And I think that's why they didn't press those shorts when you got the tariff headlines on China potential after that. So I think I think positioning definitely got zapped there, and that kind of took a little bit of the confidence away from them to kind of lean into the market in the back half of the trading day. But yeah, I think it really speaks to how washed out sentiment and positioning has gotten, especially in futures from kind of that macro cohort of investors.
Yeah.